We've reached a point where the attractiveness of cash is looking as good as it did in August and September of 2018. This is a great time to just wait for a beautiful bottom and then get in.
So we all know that gold and silver prices Q4 of 2022 and even the beginning of 2023 were looking quite strong. We saw silver crossing $24 an ounce, even threatening to go up to that $25 an ounce level, which is something we would have all liked to have seen. Additionally, gold prices were crossing over $1,900 and even approaching $2,000 an ounce. Unfortunately, in February, we have seen a major retracement with silver trading between 20 and 21 as I say this, and additionally with gold trading in the 1800s. So what has caused it to retrace? Is it going to continue? Is it going to turn around anytime soon? I'm sure that's questions that each and every one of us have right now. It could be the Fed rate hikes. It could be, inflation. It could be the war in Ukraine. What is it? And that's what I want to find out today. We are going to be talking with Lior Gantz. Lior has been an expert in this industry for a very long time. He follows gold and silver prices every single day. And we're going to ask him every single one of those questions and see what he has to say. What's causing this? Let's find out by getting Lior on the channel. But before we do, don't forget to subscribe if you haven't done so yet and help us continue to grow the channel. And check out this awesome giveaway from our sponsor, SD Bullion. How would you like to win 500 Silver Eagle coins just like this guy?
Yeah, this is Kevin.
Hi, Kevin. This is Dr. Tyler Wall, CEO of SD Bullion. I'm calling you to let you know that you won the SD Bullion giveaway of a monster box of 2022 Silver Eagles.
Unbelievable. That is awesome.
If you want your chance to be like Kevin, make sure you head over to sdbullion.com/silverseeker and enter today. All right, Lior, so welcome back to the channel. It's always a pleasure to have you on. How you doing?
I'm doing well. Thank you for having me back.
Awesome. Listen, I want to get right into it today, and I want to talk about what's going on with metals prices, both gold and silver, but specifically silver not looking very well right now. Can you tell us what's going on there?
Well, we're looking at a situation where the entire yield curve has gone positive. It's basically the lowest point of attractiveness for precious metals. We've reached a point where the attractiveness of cash is looking as good as it did in August and September of 2018. And that's the last big bottom for gold. I remember that vividly because September 2018, I personally bought a big position in physical gold. If you remember, the intraday price even went as low as 1,180 an ounce. That was my last big purchase of physical gold, and it's the same circumstances that are happening now. The positive yield curve, in other words, the after inflation adjusted return of short-term bonds, is the most attractive it's been for years, and that is very negative for both gold and silver, and that's after gold was rallying for a few weeks straight. So you have two things going on. First, the relative attractiveness of gold and silver. Two, just profit taking from a lot of traders that were in the trade for a few weeks. I think that if you look at what's happening from here on, though, now comes the important part. Basically, what happens in the next 3 months here with the Fed and with interest rate hikes going into the June meeting? I think that basically will decide the future for gold and silver. Are we going into a very flat environment for them for who knows? Or are we entering a great stage for them? And here's how this can play out in two ways. In March, the Fed will raise by 25 basis points. In May, it will raise by 25 basis points. And in June, it will raise by 25 basis points. That is the market consensus. And if you want to see the market consensus, just Google CME Fed Watch Tool. It shows you month by month, or meeting by meeting, that is, what the market predicts. So currently, that's priced in. Now, if you look at the July meeting, the consensus is the same interest rate as the June meeting at 5.25 to 5.50. So that's the terminal rate that the market currently underpins. In the June meeting, we can see one of two scenarios. Or an official acknowledgement from the Fed that that's it. We have done enough. We're not going to raise interest rates anymore. We're going to definitely continue reducing our balance sheet, but we're not on any sort of rush to raise interest rates any further. They don't announce things officially. They just say something like, there is no rush to do any further rate hikes. And that's enough to tell the markets there is no rate hikes. So that's a big one. If they can do that, that really underpins the floor for positive rates or for a positive yield curve, because it implies that the next thing that the Fed will do at some point will cut rates, and then the markets, being forward-looking, will start to price in where the real price of gold and silver are. That's really good. If they do no such thing in June, that doesn't do well for gold and silver, because it stays in no man's land, and they can continue to kind of gyrate and fluctuate for a little while longer. So those are two base scenarios. The third scenario is that we have a mini recession environment in June. GDP numbers come in, they show zero growth or even negative growth, and the Fed all of a sudden starts talking about slightly cutting rates. That is the ultimate great sign for gold. It's the best inflation, it's the best recession hedge, it's the best asset class to own in a recession, etc. That is the third scenario. The fourth scenario is an escalation in Russia-Ukraine. So as we know, the mud season is over by May. Mobilization on both sides will start in May, and by June, we will be in a full-blown battlefield environment. That could have a lot of ramifications geopolitically, and all of that is to say that it might impact the Fed's interest rate policies. So those are the four scenarios. What I think is very prudent to do right now is to stay on the sidelines and wait until June to decide how you play this. Because if there's a big sell-off, you can buy more ounces. On the flip side, if it's a bull market and you're already loaded up on the physical, then this could be time to use more greedy vehicles like miners, leverage ETFs, options, etc., to really bank on the knowledge that you've gained from following the story for so long and so closely, and now you have this favorable environment in front of you. I also want to point out that during all of this, there is a dwindling inventory situation at the COMEX that's underway. If you haven't, caught up, if you're not caught up on this, go to WealthResearchGroup.com/COMEX, and it's an A to Z on this entire shenanigan called COMEX, going back 20 years, and how they do all sorts of things to play around with the price of especially silver, of all the major commodities.
So you touched on a lot of topics there I kind of want to hit on. I want to start with going back to the interest rate hikes. You said we're looking at 25 basis points March, April, and then June, and then the
March, May, and June.
March, May, and June, and then from there
April there's no meeting.
April there's no meeting. All right, fair enough. So do you think that the Fed has pushed the interest rate hikes too far? I mean, you had mentioned a possible mini recession. Is that something that we might be facing?
I don't think they've pushed it too far, but they've certainly done all that they can to correct any mechanisms in the most interest rate sensitive industries, right? Mm-hmm. So if you think about the stock market, they've certainly changed the stock market. The money has flown from tech and growth into value and infrastructure and energy. The rotation has been historic. You see companies that used to rule the world, like Google. Now they're, all the articles I see is search is under question. Is Google over? You saw Meta and Netflix fall over 50% in 1 year. Amazon is up like 20% in the last 5 years. So that has been done. The wealth effect that people felt, retirees, etc. If one thing that the Fed tried to do was bring people back to the workforce, and you do that if you take a baby boomer's portfolio and you lower it by 20%, he says to himself, well, okay, I just lost 2 years worth of savings. I need to work for an additional 2 years. That's the theory of evaporating the wealth effect. And they've certainly done what they set out to do. Now, some people say that's not fair. They're destroying wealth. True. But yeah, that's the damage that has to be done in order to fix inflation, because the other side is that people feel too wealthy and they extrapolate into the future that this is the normal to experience what you're experiencing. Then they make bad mistakes with their savings. Okay, so that's one thing. The stock market is completely corrected. Now we can argue all day long if it corrected enough, if it's deep enough, if it, I see people saying it should go back to the 2008 levels, the 2000 levels. I've heard everything, but for the most part, Wall Street has moved money. Okay. Secondly, housing. Housing is the most interest rate sensitive industry in America, no doubt, and it has seen turbulence like never before. Even though it's not showing yet in price collapse, you're seeing it definitely in sentiment, in buying conditions, in surveys, in activity, etc. The fact that it's not showing up that much in price is because buyers for the last few years have been very creditworthy. They have incomes. They've not lost their jobs, because this is not a recession that we're going through. We're going through a reset. Unemployment is at record lows. And so you haven't seen people dump inventory into the market. There are no personal bankruptcies. People don't need to liquidate, etc. But we've definitely seen a reset in interest rates and in the housing market. And I can tell you, as an investor that also invests in funds for accredited investors, that when I call my fund managers and ask them for updates, the first thing they talk about is interest rates. So it's definitely there. And then if you look at mainstream America, small and mid-sized businesses, etc., that's where the Fed's interest rates don't do anything. The problem is the labor shortage, and their interest rate hikes haven't helped in solving that. There's a 2.5 million worker shortage. It will get worse as more retirees, more baby boomers retire than new millennials come into the workforce, and the generation after the millennials. And because of immigration policies and other considerations, we have not been able to fill those jobs, and we will not be able to fill those jobs, especially because we're onshoring a lot of jobs that were before that in China, and because we are taking on the responsibility that other countries used to do before the Russian invasion of Ukraine. So from all these, I can tell you, interest rates have not gone. They've not been exponentially too high. I don't think the Fed has overdone it, but I certainly, and you can see that because there's not a recession. But I also think that they're hitting the limit of what they can do without causing harm for no reason at all, right? You can show a kid a lesson on why he should not do one thing by getting him close to something dangerous, putting his finger next to something dangerous, say, hey, you want to touch this flame? You want to touch this flame? And you can already feel the heat. You don't have to actually put it on the flame and wait in order for him to understand fire is dangerous, because here's your major burn, and now I have to take you to the hospital. You can bring him close to it. He understands the impact of heat, and he learned his lesson. So that's where we are. We've learned the lessons with interest rate hikes, and that's why I think that in June or very close to June, they will stop raising rates. Their effectiveness has greatly diminished already. I think that they will focus more on managing expectations and on reducing the balance sheet than on interest rate policies.
So you said we have 3 more 25 basis point hikes coming between now and June, and after the June FOMC meeting, where do they go from there? And what happens after that?
So that's what I said. If the Fed gives clear indication, that's the last one. And like I said, he would not say it in direct words. He would just say, we don't know what we'll do in June. We're not sure if raising interest rates is important anymore. That's something towards the lines of what he will say. He doesn't go very direct. But that's enough for the markets to understand that he's probably done. If that happens, I think gold and silver, just like in the December 2015 meeting, where they bottomed literally on the day of the meeting, have never looked back. I think that could be a bottom for both of them, because that's a very telling meeting. And from there on, if that's the bottom, I expect gold to, I would say, to go up by between 50 and 100% over the course of a bull market, and for silver to do between 100 and 200% over the course of a bull market.
So one more thing I want to get in, and then we'll move off of that. What about...
just to say, we're definitely closer to a very important bottom than we are to ending some sort of a rally or a move here. This is a great time to just wait for a beautiful bottom and then get in.
Fair enough. What do you think the interest rates have done? We've seen a weakening of inflation, but it still seems pretty high. And do you think that number, it's on paper, but if you talk to people, it doesn't feel like it's actually gotten any better. Do you think this is? Do you think this is real?
So, the CPI is what Wall Street and the world operates on. So whether or not it's reflective of the real, representing the real world, everybody knows it's not. But it doesn't matter if it is or not. What matters is people trade off of it. So just don't treat it as if, hey, that can't be true. Just use it as an indicator of what to do with your money, right? If it comes in hot, even though you say to yourself, that's not hot. I know inflation is like 11% or 12% or 18% or whatever. If it comes hot in Wall Street terms, it means something. If it comes weak in Wall Street terms, it means another thing. It's a trading indicator. So just put aside, trying to be like a avenger for the people when you talk about the CPI. Everybody knows that inflation includes energy, food, and housing. Everybody knows. And nobody thinks that energy, food, and housing is not important. So the CPI is definitely not a representation of real world inflation. Certainly not for the average person. Okay. What I think in real terms is happening is, because we are deglobalizing, and a lot of supply chains have gone from being very trustworthy to the point where, an American retailer like a Walmart can order from China. That thing goes through 30 ports, clears customs a gazillion way across the world, and gets to your nearest Walmart fresh and ready. That's not the world we live in anymore. Semiconductors were the first thing to go. You saw cars waiting in lots for chips for months. This is going to happen in other commodities and other finished goods and other services and other products. We are going to change the way that the supply chains go around the world. And we're moving things out of China. We're obviously in Europe, the energy market has completely changed. And in general, because of lack of workers in China, their wages have gone up a lot. So now that there's about 52, 54 countries that manufacture cheaper than China. Now, not the same quality, but they'll get there just like China did. So manufacturing is kind of moving away from China. And now where is it going? So this whole reset is very inflationary because you need to build new factories and get all these people skilled. Okay, so training, education of new people, recruit them. This whole thing, it takes time and a lot of money. So that is very inflationary. That's not going away. And I think that that's why we're in an inflationary environment for at least 4, 5, 6 years here. So I think what you'll see is choppy CPI readings for the next 2, 3, 4 years until companies, governments, etc., are making the efficiencies needed to enter this new world that we've commenced upon, but obviously have not been fitted for yet.
Okay, Lior, well, that's about all I had for you today. Really quick, though, if anyone wanted to know more, you have a wealth of insight that I didn't even touch on. Is there anything they can do to follow you right now?
Yeah, definitely. Two things. One is if you go to WealthResearchGroup.com/portfolio, I've made my entire portfolio available. It goes through each company, and in one sentence, what I really like about it and the price that I'm looking to get into that particular company. It excludes all small cap, very volatile type of stocks and focus on the more, the value companies, the long-term investments. So definitely check that out, and then do your own due diligence on each of them or the ones that you feel like that you like. Secondly, it's the flagship newsletter. If you go to our website and sign up for the free newsletter, it goes out 3 times a week, and that's where you stay up to date on everything that I think is happening in the world, and personally what I'm doing with my own investments.
Perfect. Well, I'll put links for all of that down below for anyone that's watching and is interested in that. And as always, Lior, it's always a pleasure to have you on. I hope to have you on sometime here in the future as well. Thank you.
Thank you.
So there you have it, guys. That was Lior Gantz, and it's always a pleasure to have him on. He definitely had a lot to say, and I hope that you guys enjoyed the interview. We will try and get him on again next quarter, but between now and then, if you haven't done so yet, make sure you subscribe. And also, I'll put a video up above. If you haven't seen that video yet, that's the next one you should watch, so go over there and watch it right now. Thank you so much for watching, and we'll see you next time.